So we feel like 2019 will also be a good time for the cement sector. In terms of cost, it will benefit from lower oil and coal prices because power cost accounts for around 35% of its cost of goods sold. The cement companies will also benefit from the recently introduced safeguard duty of 8 peso 40 centavos per bag on imported cement. So that should likewise help prices stabilize. Okay. So notwithstanding our very positive outlook on the cement sector, we are removing Eagle as one of our stock picks. So we just learned recently that despite the high demand for cement, Eagle could not deliver or capitalize on this because it's encountering difficulties in operations. No, it's encountering some challenges in its factories or executing on its operations. And despite the safeguard duty, the company said it has no plans to increase its selling price. Our fair value estimate for Eagle is around 15.90 and the stock is trading close to that value. So because of that, you know, we're just removing it from our stock picks. We feel like it's fairly valued. And in terms of EV EBITDA, the stock is trading at around 12 times EV EBITDA versus regional average of around 9 times. Okay, on the other hand, CHP might be a good trading opportunity for people who want to capitalize on the strong demand for cement. Okay, last year, CHP was one of the worst performing stocks with the share price down 61%. It was affected by high input costs due to rising oil and coal prices. It also had high tax expenses due to the utilization of its deferred tax assets and the suspension of one of its kilns resulted from the landslide incident by its primary supplier. However, all of these issues have been resolved. As we know, prices of oil and coal have gone down. We asked them about the deferred tax asset issue, and almost all of that has been used. And the quarrying operations of Apoland and Quarry has already resumed. So its kiln is now operational again. Okay, and of course, it will benefit from the imposition of safeguard duty of 8 peso 40 cents per bag of cement. So that's around a 4% increase in the price of imported cement, which should help CHP. Valuations, because of the sell down, we feel have become very attractive, with the stock trading at around 7.3 times EV EBITDA. Okay, this is versus the median EV EBITDA of around 9 times. So CHP could be a good trading opportunity among the cement companies. Okay, so another sector that will benefit from falling oil prices would be airlines, because oil accounts for a big portion of total costs. Aside from that, the stability of the peso should also benefit Cebu. Aside from that, we've always seen Cebu Pacific delivering strong revenue growth. In 2019 will be the same. We're forecasting revenues to grow around 17% this year. In terms of valuation, still very attractive. You know, despite the fact that the stock has rallied from its low, it's still trading at 5.5 times EV EBITDA. The regional average is around 7.9 times EV EBITDA. So there's still some upside to this stock. Okay, so now let's move on to the property sector. So this year, we're not that bullish on the property sector. It's actually quite mixed. So on the residential sales, we're not too positive because we know that lending rates or mortgage rates have gone up quite a bit, and because of that, the amortization on property purchases have gone up quite a bit. However, on the other hand, we're still positive on rentals because as far as offices are concerned, for example, there's still a unexpected shortage or very tight supply in terms of offices. So because of that, rental rates are still expected to increase, and anybody who comes out with supply is expected to be able to lease out almost 100% of whatever supply they come out with. And malls, at the same time, we're seeing increased demand from restaurants, and still some names coming over, like we'll have IKEA this year. So the demand for commercial space is still very strong. So rents are still fine. So because of that, our strategy this year as far as residential sector is concerned, we want property companies with more rents rather than those that are focused on residential. And if ever these property companies are focused on residential, we want them to be more focused on higher end buyers, which are less sensitive to higher amortization rates because they pay in cash. Okay, so because of that, our stock picks are Mega World and Ayala Land. So Mega World, the reason why we like it is because leasing operations account for around 52% of operating profits, and 60% of its buyers for their residential projects pay in cash. And the stock is very cheap. It's trading at 10.2 times PE. This is a discount to the industry average for around 19 times PE. Ayala Land, we also like it. Leasing business accounts for 32% of operating profits. And although the residential projects business accounts for a bigger chunk of profits, 63% of its buyers actually pay in cash. So it should be more resilient to the increase in interest rates. And it's trading at 20 times PE. This is slightly above the industry average. However, historically, Ayala Land has always traded at a premium to the industry because of its strong brand and pricing power. Okay, so another stock that people have asked about is SM Prime. What about SM Prime? Do we like it? Yes, we do. In fact, it's the most resilient to the impact of rising rates, since 76% of its income is from rental properties. However, again, the stock is very expensive. So SM Prime currently trading at 31 times PE. Industry average is around 19 times. So that's a huge premium. And aside from that, the stock is trading at par with our fair value estimate. And our fair value estimate includes the value of its reclamation project. And we know right now that the reclamation project is facing some challenges. So in our fair value estimate, the value of the reclamation project is around 9 peso per share. So, that's a big risk in case the reclamation project does not push through. So we're just a bit cautious because of that. Okay, our other stock picks include Ayala Corp. Ayala Corp is still a good proxy to the index given its various leading subsidiaries in banks, properties, telcos, utilities, and recently it has entered into power, and that business is also showing some growth. Okay, a lot of people might be concerned about its recent share offering. Will the stock actually, or what does this mean? Well, it shouldn't affect the company because what essentially happened was one of the shareholders just sold down its ownership in Ayala Corp. So it's a secondary share offering, and there should be no impact on the company. So it doesn't change our view on it. Okay, another stock that we like is Bloomberry. It's part of our picks. And, we feel like it will benefit from the possible stimulus that people are speculating that the Chinese government will implement, given that the Chinese economy is encountering some difficulties at this point, or encountering a slowdown. Okay. Although its VIP business right now is encountering some challenges due to greater competition from Okada, I think we should focus on its grind business or its mass market business, which is doing very well, notwithstanding the others. And the stock is trading at a discount relative to its regional peers, so we continue to like it. We don't see any problems with Bloomberry.